Good day, my name is Dean Crocker and I'll be running you through the latest BHP bulletin, ERA. BHP released their first half 21 results, in which revenue generated increased by 15% to $5.6 billion. Underlying EBITDA of $14.7 billion EBITDA resulted in a margin improvement of 56% to 59%. Net debt declined to $11.8 billion on the back of strong cash generation, whilst the strong balance sheet allowed for an interim dividend declared of $1 per share. This amounts to a payout ratio of 85%. Looking at the various divisions, the iron ore segment as well as the copper segment both benefited from higher prices and resource prices. Iron ore segment actually benefited significantly greater than that, as they had unit cost increases of 10%. If we're looking at the coal segment, they were hardest hit by the COVID-19 impact and unfortunately impacted both in terms of a higher unit cost as well as lower thermal coal prices. The petroleum sector was also impacted and resulted in a decrease in EBITDA of 50%. Just looking at the impact of the results, the share price increased by 3.2% to close at 455 Rand on the day. This outperformed the CAPS Swix since the start of the year by 12%, whilst the year-to-date return amounts to 22.48%. Looking at the consensus, both consensus were revised up, both earnings per share as well as revenue, whilst if you're looking at purely on a PE basis, it seems to be trading at a premium to its peers as well as historical average. Based on the assessment, we have assessed BHP looking at the spot prices to understand what has been priced in and what has been priced in, and based on what we can see, it would appear that the latest spot prices have not been factored into consensus earnings estimates. As such, you can see that the graph on the right demonstrates the EV/EBITDA at spot relative to the EV/EBITDA at consensus. This does provide some additional upside expectation. And if you just look at the prices factored in, the achieved iron ore price was roughly around $103, whilst right now the spot price is $167, showing significant improvement. We do expect the achieved iron ore price for the division to be somewhat in between there, as there is a period in time which they have to trade. Achieved crude oil prices at $41 relative to current spot of $63, as well as the copper price of about 3.32 dollars per pound. So our assessment, headline earnings of roughly about $5 billion, the reduced unit cost over the past 5 years by 17%, whilst the balance sheet remains very strong. The net debt to EBITDA at 0.92 times, and this on the back of the stronger cash generation. The business offers a high quality portfolio of assets and diversified across various divisions as well as countries. However, there is some forecasting risk in the sense that the company does face headwinds. We can also look at the seasonality and significant swings in resource prices, which also offers a bit of risk on the valuation. Whilst the four core divisions remain well diversified with a blend of defensive and cyclical growth stocks, in the near term we do however see that the unit cost should benefit from strengthening of commodity prices. Spot EV/EBITDA ratio of about 3 times, and based on all the facts we feel that the company does still have a significant upside and thus maintain an overweight recommendation. Should you wish to place a trade, please speak to either your financial advisor or the trading desk. Contact details provided on screen. Finally, please take note of the disclaimer and have a good day.